All right, well, let's get it back on. Welcome back to the Family Banking Podcast. I'm Chuck.
I'm John.
All right. And, the last episode, John, we began to talk a little bit about policy design. I wanted to take that back up in a little bit, but I just thought we would start at sort of the 50,000-foot level and say the biggest idea here in private family banking is preserving your capital. And as I said, like Warren Buffett, never losing money, never going back. Just that alone is a huge benefit. So when John started his policy, he wasn't an agent. He was learning. He was just getting ready in his business, and he was saving money, and he had some money saved up. And so he capitalized his policy, and you've used it now at least 2 major times, right?
Yeah, I guess
Used
2
it for
or
the
3 major times.
down
Yeah, so I
payment
bought a piece of property, did that, built a house on it, sold it. Was able to pay the loan back from, borrowing it against my life cash value on my policy. Hopefully, people understand what that means, and we can get better.
Yeah, let's talk about that.
I think we need to kind of talk about what is a whole life. What's a whole life policy sold by private family banking? What's the key? 4 key principles or abilities.
Yeah. So if we were going to talk about that, so the first big idea is to preserve capital. How do we do that? Well, in a policy designed for quote-unquote banking. Now let's talk about banking. Banking is just the process of money running through your life, paying bills, acquiring things, building a business, paying a mortgage, whatever. Money's going to come through your life and you're going to do banking. So the first thing we want to do, instead of flowing the money into a regular bank and a checking account only and letting it sit there, we're going to flow it through an account and into this new account that was based on a policy we call a high cash value whole life insurance policy. So whole life insurance is a way to build cash and have that money capital available to you for the rest of your life, where a term insurance policy is just that. It's only good for 10, 20, 30 years of a term meaning the term of the policy, a life cycle. And at 30 years, the most you can buy, it ends. And if you don't die, you get nothing. All the premiums you pay, although they're smaller, our policies are going to cost you more per month, or you're going to put more money in. But a portion of your money is kind of threefold. 1, it's going to pure whole life insurance. 2, some is buying a term insurance rider that we use to build the size of the bank. And 3, we encourage you to do what are called optional but very critical paid up additions. So there's 3 components to that premium: base whole life, there's a term life rider, and then paid up additions or level LPUAs or PUAs, paid up additions. What you're doing there with the third component is you're buying little pieces of life insurance and adding some cash to it, and that makes you be able to build your cash pile bigger, faster. And so why would you do that? Well, we all want to try to save money, and we all want to try to avoid paying interest. This way, even if you're not going to we're going to encourage you not to liquidate the account. That's the big mental shift change. So talk about that first piece of property. So you had about 20, 25, 23,000, I think you started your policy with. And so you put that in, and it gave you approximately like 20,000, I think, of which you went and bought a piece of land. It happened to be just the right time. We couldn't find land at that price today. But you did.
So we bought the land.
You were a cash buyer.
I was a cash buyer.
In the eyes of the seller.
But
you actually borrowed money against 25,000. Here you borrowed about 23,000, as I remember.
Something like that.
And you bought the land. Now you have 25,000 in your policy, and you had a piece of paid off land. And then we went where? What did we do with that? We went to a regular bank to get a construction
regular construction loan from a bank. Obviously,
But you had equity in the property. So
it was a clear title, basically. That's what you would call that. So,
awesome.
Yeah.
Which is a lot easier to go to a bank and get a construction loan when you own the property. Paid for. Use it as collateral.
You can use it as collateral. That's
in the meantime, you set yourself up to pay that loan back at about 5 to 5.5%. I can't remember what the interest rate was. And you wanted to pay that back on a routinized basis. So
you can
put
set
a
up
extra money.
You can set up an auto payment every month. If you wanted to pay it down, or you could wait at the end of the year to pay off the interest. You could do that.
And so the way the policies are designed, if you didn't pay a $20,000 loan off at the end of the year, what would happen?
They would take it away from the cash value in the policy.
And then if you've paid a payment, a premium payment every month, part of that premium is adding to the cash value during that year.
Right. You're
so
already
at the end of the year, you're going to have enough extra cash value if you want to absorb the compounded interest and roll it into the loan.
Right.
Let's use 5%. A $20,000 loan at 5% would be $1,000.
Right.
So at the end of year one, you'd have a $21,000 loan.
Right.
And you just roll forward.
Yeah. If you didn't happen to have the cash to do that.
Yeah, to pay the loan down. And,
right.
And there's nothing wrong with that.
No.
Eventually, you want to pay that loan back. But if you want flexibility and you have other options that you're working on, or you're cash strapped, or maybe you have your money tied up in a project or whatever, you might have to do that.
Right.
It's not the end of the world.
Yeah. I think one thing to think about is what's a lot about why do I take a loan out against it, and should I, and the value of the policy is that you're creating more flexibility in your life by having a whole life policy. That's the root. Why would you do this compared to a cash buyer?
Well, you're also getting a death benefit.
You're getting a death benefit, but like the core principle is you are trying to be as much like a bank as possible without having to be regulated and have the storefront,
$20 million in assets, or whatever it is,
whatever the regulations have to be in your state. But ultimately, the more you can act like a bank, the more you're going to be able to succeed in the financial realm. So
kind of blowing that up big again, this idea of private, we're kind of going through that. You own it.
Right.
So you actually have a contract. That contract, we like to call it the and asset. The contract allows you to have a death benefit if you died prematurely or later in life. You have it for your entire life. And it builds cash value, which is an asset category, like equity in a house. And you can borrow against that at any time for any reason without approval. And you have a guaranteed interest rate cap of 8%. And your money's going to compound tax-free. And it's going to be protected from lawsuits. And. So thus, the kind of the and asset. A friend of ours, Caleb Gilliams, wrote a book called The And Asset. I recommend it. It's a good little read. But we do that too. I have my own book. We have books in our bailiwick of private family banking. But that is what it does. It really augments what you can do and get. And when John mentions flexibility, there's also flexibility. I mean, you set yourself up for a monthly premium, but if you needed to reduce that, you can even take that down to it. If you do a loan and you can't pay the loan back, you can wait. I showed a guy last week. He wanted to know how long he could wait. Well, I extended his loans out 10 years. And because he capitalized it so strongly in the beginning, he was able to wait over 10 years without making a loan payment or interest at all and just kept rolling it over. Now, he probably won't do that. He wanted to know how much flexibility.
How much flexibility does it have?
Which is great.
Fantastic. Yeah. I think that, so why is a whole life policy? I think what we could drill down is, why is this a good idea? Well, I think if you ultimately, what's the purpose of money? Well, it's you got to live, right? And then the second thing is, okay, if you're already paying for what you're doing, you're also creating an inheritance. So how can you preserve that inheritance? And the question is, why don't I buy gold bullion? Why don't I go buy, I don't know, stocks? Why don't I go buy a lot of your life? You want to make sure that you can pass it on to your loved ones and not being taxed to death either.
So there's a really kind of pointing out two key components. And so, as we like to ask, the question in economics is always compared to what? So why would you do a high cash value whole life insurance policy? Well, compared to what? Compared to putting the money under your mattress, probably not a good idea. Compared to putting your money in a bank, we know that's not a good idea. I hope you know that, listeners. Thirdly, you could play the market, but what are you exposing yourself to? Market volatility. What if you put it in real estate and a real estate market crash? So real estate's not always perfect. We like real estate, don't get me wrong, but it's not, it's not as liquid, right? If you go buy a rent house and you're making net $200 a month and you've got $100,000 tied up in the rent house, how far is that $200 a month going? You'd have to have 20 rent houses to even make whatever it is, $4,000 a month at $200 net profit. Right now, some of them are lucrative to that, but actually, the rent market is so packed with buyers that the net rental, because the prices are going up, and if they can rent them cash positive, is $200 is maybe a little slim, but you're not going to make $1,000 net a month unless you're
on one home
vacation property on one home. Maybe you
Yeah.
do a VRBO rental, and then you have to fight are you
Right.
going to get the rentals that you need?
Yeah. How about we attack a question that, or talk through a question that, the question of, okay, I put this money into a whole life policy, and then, I stack, first year 20 grand, second year 40 grand. I'm putting 20 grand every year for, let's say, my whole life.
Right. Wow.
For the next 80 years, 20 grand a year. Let's say I do that.
That'd be awesome.
Right. Now, the question is, they say, okay, I've put in, let's say over the course of a lifetime, I put in $500,000 into this whole life policy.
Mm-hmm.
I die, and the death benefit has always been $1 million. Right. It was $1 million from day one.
Well, it would probably be more than $1 million. If
Let's
it was
say,
$1 million, the death benefit's always going to grow as you pay premium.
Okay, it will grow.
Go up.
Oh, okay. So
now, it'll go up. It depends on the term of that term rider. It may go down when the term rider expires, but then it's still going to go back up. So you could start out at $1 million. Term rider drops off at 30 years. It could go down, and then you keep paying in your 60s or whatever.
Right.
It's going to go up. But let's say it's $700,000.
Right. Okay. So then the death benefit is $700,000.
Mm-hmm.
Okay. So you're saying. So then the question is, the question that I'm hearing is, okay, I've paid into it all this time, but then, the cost of the insurer is actually going to be lower because the cash value has built up over time. Mm-hmm. So now they're on the hook for less money. Right, mm-hmm. They're still paying maybe out a death benefit of $700,000, right? Mm-hmm. But if they had just died in 10 years, they wouldn't have put in the $700.
Right.
Now, the question is, obviously they're still giving you a death benefit, mm-hmm. right?
Mm-hmm.
But they did put in $700.
Yeah, you would have to look at a policy. Right. I don't have one at my fingertips, but it's usually it's really like your policy. You maybe have, I don't know, 70,000 in it, and your death benefit is over $2 million.
It's like, I think it's like 1.7 or
1.7 million. So I mean, that's a pretty big multiplier.
Right.
So most of your life, while you're raising kids, you're going to have that kind of leverage.
Right.
Later in life, what's happening is the cash value is growing, like you said, maybe to $500,000.
Right. Right.
Well, who wouldn't want at age 60 to have $500,000 that you earn tax free,
right,
and be able to access that and duplicate that money? The value of this is not just building up cash inside the policy, but using it for other things. Using it for things you would do anyway, like buying cars,
right,
improving the house, or remodeling, or real estate investing, rent house investing, whatever you get into, or just basically using your policy to live life where you would have given away the opportunity cost of earning that money, because as we show you when you get together with us, you're earning money in more than one place at the same time. That's the extra value. And then the death benefit is the kind of the icing on the cake.
Right.
It's protected. So we have a thing in life insurance called human life value. So what you're really doing is buying life insurance up to the limit of what they will insure you for, which is your ultimate highest net human life value, not net worth, but the worth of your life over time based on your age, health, and how much you're making currently and what your net worth is. So you're able to leverage your asset called you by buying this policy. So that's the real advantage, including the fact that if you die prematurely, you're going to get a huge multiplier to your family and your heirs.
Right. But the question is, a person would say, well, what would be the difference if I just got, lack of a better term, what would I just get regular term and invest the rest?
Right,
like
that's A.L. Williams. Yeah, Dave Ramsey, A.L. Williams, that's the now Primerica people. That saying came out of the 1960s and 70s with A.L. Williams. Well, how's that working out for you? I would ask you, compared to what? So during that whole time, I've had this very stable, never-ending, always growing, compounding interest inside my policy. You expose your money to the stock market. And so if I show you what the stock market did since the year 2000 with $100,000 and watch the market go up and down, and you lost money, then you gained it back, then you lost money, you gained it back, compared to what you would have done putting in that same time period $100,000 into a policy, it's night and day.
Different. Now, but again, they're getting to the point of, well, the insurance now is just using your money to pay less money to you. You're willingly giving it up. That's the way they're thinking about it.
That's the way they're thinking, but the facts are the facts. The fact is that they're first of all giving you a benefit if you die prematurely.
Right.
You're going to take care of your family.
Right.
Secondly, they're giving you the net present value of the death benefit they use during your entire life, which is huge if you come up with good ideas on how to use that money. Thirdly, they are investing that money and making money for the company, of which when you join a mutual insurance company, you're an owner of that company. You get to share in the profits of the company. So they are returning to you profits through dividends when they're paid. And you have a contractual right to get a dividend when it's declared.
Right.
And the companies we work with have declared dividends for over 100 years.
Right. Now,
without a miss.
Right.
Consecutively.
Now, the thing is, what I would question them is, well, this is a tool, this is a way, like, nothing is for free. If you put your money in a bank, they're going to charge you maybe an account fee or whatever. So everything comes at a price. So I'm not, bank's not just going to say, oh, I'll willingly put your money in my bank, I'll protect it, take care of it, and I won't charge you anything for it. There's a certain sense that...
Well, they're also not paying you much interest, if any.
Right.
The fees kind of wash it out.
Right. But if you took away the life part, the life insurance part of a whole life policy, and you just said, you can put your money here, we'll charge you a management fee, basically, and give you dividends, and we'll let you collateralize it anytime you want, night or day. That's a pretty cool feature. Then if you think about the life insurance as a secondary benefit to it, it kind of makes you step back and actually realize what you're doing with your money. That's where you really see the banking part of this. I feel like if you separate, if I just took away the life insurance part of this, I would see the value of it as a tool and less of a
life insurance just makes it all the sweeter.
Yeah, it makes it sweeter. Because if you just said, I'll give you all these benefits, and you left out the death benefit, you go, oh, that sounds pretty cool. I think I might like that. You can't get collateralization with a high yield savings account.
Well, you can. You could go to another bank. You could go to another bank and try to go get a money loan now on a savings account and see what they'll charge you.
True.
They're not going to charge you 5% or 5.5%, which is where we're at with our policy loans. And you're going to have to qualify. How much paperwork did you have to do when you bought the house?
True.
How much you had to show that you had a job and income. When you get your policy, if you lose your job, you have access to your policy whether you have a job or not. It's your money. You have rights to the money. It's technically the insurance company's money, but you have a claim against it. Contractual claim. Awesome. Yeah, you make a good point. The death benefit's just icing and spice in the sauce. I mean, who wouldn't like to pass? So that gets into that multi-generational private family banking. How do you make this a family bank? And that's without Rothschilds banking like the Rothschilds. What they did is they created essentially their own family bank. Of course, they had lots of money. They didn't really need an insurance company. But the Rothschild, Mayer Rothschild, he made sure that any of the children and heirs that borrowed from the bank had to return that money with interest and a gain, and they had to report on that on a regular basis. What are you doing with our money? And so that's where the idea came from, and then we use this because us poorer people don't have the Rothschilds' money, but the insurance company is very wealthy, and they can help us with their model, and they have billions of dollars of assets, and we get to participate in that. So the idea of family banking or multi-generational banking is not just passing on the death benefit, though that's part of it. It's also, can you create a bank and allow your children to access that bank if you're the patriarch and the matriarch? Or can you set up several policies, policy on you, a second policy on you, a policy on your wife, and a policy on each of the kids? Now you have this aggregate family bank. You make some bylaws, and we work with generational planning. We'll take on clients and create some coaching and teach them how to do that. So that's another aspect of it. And when you do it that way and you start as a family and you have a principled family charter that says what the rules of the road are and inspire people to get involved, you could do that. Absolutely.
Yeah, no, it's good. There's a lot of, it's somewhat abstract but very simple thinking behind it all.
It is.
Yeah.
I mean, giving just cash gifts to your kids, of course, you're going to have to pay taxes on that money. You can gift money today. There's $16,000 per child, and the couple can give $32,000, $16,000 from mom and $16,000 from dad. So you can do gifting, but by putting it in a policy and teaching them how to use it, they're getting that leverage. It's really about leverage. That's what the policy really brings is leverage to your life and to your money flow. And so, I mean, I always say this: if I could show you a way that if you're in fairly good health, we can get you approved to be able to teach you to use your money in more than one place at the same time and make money on all or most of the money that's going to flow through your life automatically already. You're going to have money flow through your life.
Right.
So the question is, how does it flow through your life?
Right.
I could show you a way to make money on all that money that flows through your life, or a good portion of it.
Right.
Would you like to know?
Right.
And it's sort of like evangelism, Do you think you're going to heaven? No. Would you like to know for sure?
Right. Yeah.
Do you think you can build up,
That's a good way to look at it.
Some capital, yeah. Would you like to know for sure? That's right. We can show you for sure. The thing, again, I tell John all the time, what I love about this business is I love it. I do it. I have multiple policies. And I know that if people will follow the methodology, they're never going to get hurt. I don't have to go to bed worried about what the stock market is. I don't even look at the stock market.
Right.
I couldn't tell you what the Dow Jones did today at all. But I know my policy made money.
Right.
And I've got plenty of money in there. And it's making me compound interest every day.
Right.
Every day. And then I wait for those dividends to pay and I reinvest them. And the thing just builds and builds and builds. And we have graphs inside of our policy illustrations that show that compound growth. We call it the wealth curve. So what happens? So in private family bank, if you join us, you'll learn this term called the wealth curve. So wealth curve is basically the exponential growth of money uninterrupted. And that's the key, uninterrupted compound interest. And when you step off the wealth curve, meaning you exhaust your capital, you spend cash, you either take money out of the policy, no, don't do that, but if you did, or you take money out of your cash account and go buy a car, that money's gone.
Right.
That money's gone. You fell off the wealth curve and then you're starting over. A cash buyer has to build up $30,000 or $50,000 to buy a car. He goes, buys the car, and he starts all over again. His curve is going like this and like this.
Right.
Like this. Our wealth curve goes just like this, and it goes asymptotically, exponentially higher.
Right.
Because of compounding.
Right.
A penny a day doubled every day.
You're adding to that as well with the cash value.
Yeah, you're adding to it. And you're adding to it. Not just the interest, but your additional payments.
Right, because then that starts to compound on itself too.
Amazing.
That would be also another reason why you can see that hockey stick kind of.
Yeah, it's a hockey stick. Yeah. That's what you want, man.
Right.
You don't want that ragged edge.
I mean, you can't, like you said, you can't sell it to someone and hurt them. It's pretty safe proof as long as they don't do anything dumb with the policy, like try to cancel it and liquidate the cash value or something like that.
Right. I mean, that would be really not what we would want to do. If people,
let's say, what's an example? What could, in theory, happen depending on the contract? Someone says, "Oh, this isn't working for me." They don't understand it. Number one, let's say just pure ignorance. They don't understand it. What would be the tragedy of that?
Yeah. I think there's three things. One, the tragedy is they don't have good money management.
Right.
And so maybe they shouldn't have done it in the first place.
Right.
The second tragedy is they've put in money and now they're going to get their cash out, but they're not going to get all their money out because some of that had to pay all the money
surrender
they paid
charges or something.
Yeah, well, no, they had to pay for the life insurance, especially early in the policy.
Okay.
You're not going to get every dollar back in cash value. They get all of their cash value back, but your cash value is not going to equal the cumulative premium paid till 4, 5, 6, 7, depending on how old you are. For younger people, maybe 4 or 5 years into it, you'll have all your money back.
Okay.
So if you quit at that point, you'd get all your money back. You wouldn't get much more than your money back at that point. If you wait 6 to 10 years, you may get some gains back.
Right.
But again, compared to what? If somehow you're enticed that there's a better way to put your money somewhere, you might want to do that. I don't know why you do that. Plus, you lose the death benefit.
Right.
If somebody catastrophically lost their job and got totally injured and disabled, maybe they would have to do that.
Right.
But there's so much flexibility in the policy because if you're paying every month, you're building cash value, you can actually, in some of the younger people after 3 years, you have enough growth every year to borrow the entire growth from the year 3 and pay all the premium for year 4 and buy yourself a whole nother year.
Whole year until you can afford to.
Now, if you were already borrowed all the money out of it and you couldn't do that, then, maybe. But, most of the people that are down a younger level, we're starting them out at $200, $300, $400 a month. And, if you need to go to Uncle Sam or Uncle Mary or Aunt Mary and Uncle Jim or somebody and go borrow 1 or 2 months of premium on a no-interest family loan, I would do it. I would try to keep that policy alive at all costs. I would find a way to cut costs. Going for lattes and, tighten your shorts a little bit, tighten your belt, and, try to figure out a way. But does it happen? It does happen. Most of our more mature people that are getting into this, that would never happen because later in life, the multipliers are great. You get to be, if you get in at 25 years old or 26 years old, and you're in it till you're 46. At 46 years old, you're getting probably 2, 3, 4 times your money. Every dollar you put in premium,
right,
you're getting $4 in gain. And so even if you paid $1,000 a month was your scheduled premium,
right,
you'd go find some way to pay that $1,000
because you're getting $4 back.
Because you're going to get $4,000 back. You can turn around and whoever you borrowed it from, you could pay them back in 2 weeks because the money settles in the account. It takes about 2 weeks. So why wouldn't you do that?
Right, right.
You wouldn't do it because you really don't understand the product, or you're just really reckless.
Yeah.
And we've repositioned people that had high interest credit card debt. They get their policy, they pay off the credit card, and they start rolling that money. And it's a miracle turnaround. It really is amazing. Short of a miracle, certainly, but it's certainly amazing.
So, but by doing that, then you owe the insurance company, not the credit card company.
Right. And then and eventually that money's coming back to you in dividends anyway, so you're not really paying yourself back the interest, but you are paying into the profits of the company, and you're a company owner. So in that sense, a distant sense, you're paying yourself back. So, I think that there's just nothing like it. There's no other financial product out there. I think it is misunderstood by many.
Right.
And it is more caught than taught. I think you've said that yourself, that's the kind of the way you kind of look at this. And I think that's the way you have to come bring people along, because this isn't something that there are several of my clients that after 1 or 2 meetings, they're like, the lights are on, and I almost can't stop them from starting this. Those are always nice. There are some people that they've either talked me to death, or I felt like I talked them to death, and they come along. And there's some people that just don't come along. And that's fine.
Yeah, that's fine too.
Yeah, I would rather have somebody willingly and knowingly come along and do this. And really try to understand it the best they can. But even my younger policy holders, like 2 of the guys that are on our team now as agents, in the beginning, they really didn't get it, and they weren't good at explaining it until they did it.
Until they started doing it.
They mentally understood it. They really couldn't articulate it because they hadn't practiced it. So they're a testimony. Like my one guy, he just bought a second policy because he's like, I went too small. And that happens a lot of times. Younger people go too small.
Cool. Yeah. Well, I hope you guys enjoyed this, and we're going to keep on trying to do these podcasts for you. But if you guys know any more, have any more questions for us, feel free to email Dad. His email's all over the place.
Yeah, banking@privatefamilybanking.com will work.
And we'd love to hear some questions and talk about them.
Absolutely.
Because that helps us give some talking points and, give you guys some good stuff to chew on and understand. Any other thoughts before we close?
I think I'd like to just say we have a growing community of well over 100 people. I think almost 120 now. Not everybody comes to my quarterly meeting, but I have an online Zoom quarterly meeting, and I invite guest speakers. We've had one of our clients, or one of our members of our community, is a real estate syndicate owner.
Oh, there you go.
And he's looking for investors, and the entry point is pretty good. I have people, and I'm looking at this maybe first quarter next year. I'm going to buy into an Amazon business. We have several pastors in our team of clients that are in an Amazon business where it's a hands-off. You're more of an investor. I have a third opportunity for a for-profit company that if you're interested in that, you get involved. If you get a policy, you have one of the conditions is you have to have a policy, and there's lots of ways to leverage your policy into a for-profit company that we hope to see grow big and to multiply as it already is. So there's many opportunities, well, let alone some of my individual clients are loaning money to one another for business opportunities up to over $100,000, not small change, and down to $20,000, a little smaller. And so those things are happening. And this community has been together now just over a year and a half. So things are really booming. We're growing every week. I get try to talk to people mostly every day. And I'm pretty available from 6 a.m. Central Time or 7 a.m. Central Time to 9 p.m. Central Time, and it's banking@privatefamilybanking.com, and you can certainly catch me there, and I'll hook you up with a meeting calendar. And John will be getting his calendar going. And he'll be taking appointments.
Hopefully in another month or so, probably.
And we're doing. I'll just do a shout out. We're doing a Fight, Laugh, Feast Cross Politic Conference.
See us there.
Come and see us there in Fort Worth. We'll be there in Fort Worth. At the Will Rogers Center in downtown Fort Worth, October 31st through November 2nd. We'll be there. We'll have a whole team there. John will be there. My 2 guys out of California will be there, and we'll be having a lot of fun at the booth, some games and fun for the kids. We'll be having giving away a Byrna which is a non-lethal projectile stun gun kind of thing for non-lethal, not required to have a license, but it's self-protection item called a Byrna, B-Y-R-N-A, Byrna. And it's really cool. I saw a police officer with it at a wedding we were at on Saturday. She had a Byrna.
Yeah.
She said she can knock some people down with that if she needs to. So
that's pretty cool.
Yeah. Anyway,
you could too.
Yeah, you could too. And then we'll be at the conference in April for Pastor Joel Webben and Right Response Ministries. That'll be here in what's the name of the town?
Georgetown?
Not north of Georgetown. Temple, Texas. Yeah, we'll be there in April. I think it's early April, so we'll get some word out about that. But we thank you for listening.
Yes.
That's again banking at privatefamilybanking.com. Give me an email and we'll chat. We'll get on the calendar and go through the numbers in your life.
All righty.
All right, John.